Hey everyone, it's Alex Morkate with Real Estate Shorts. Today we're going to talk about net present value in commercial real estate. We're going to cover what it is, how it's calculated, how it's applied, and what it really means to you when you apply it. Let's get started. Okay, so first, what is it? Net present value, or NPV, is effectively the value that you are either creating or losing in today's dollars for a given investment. So I'll paraphrase. If you were to invest $1 million today in an investment, how does that $1 million investment relate to the value of the investment? If it's worth more than your investment, than your cost, you're creating value today. And if you invested too much, if you overpaid, because the value is worth less than that initial cost or investment, you've lost value in today's dollars. And so net present value is that measure of value creation or value loss. Mathematically, net present value is the difference between an investment's present value and its initial cost. So I think it'd be really important to try and distinguish and differentiate between net present value and present value, because oftentimes they get used interchangeably when really they're referring to two different things. So present value is the value of everything that happens after you control and purchase the investment. So let's say day after tomorrow and every day thereafter, I'm collecting rental revenue, I'm paying taxes, I'm considering refinancing or selling the property. At some point in the future, I'm going to have this stream of cash flows. Present value addresses that future stream of cash flows. What is that stream of cash flows worth? Net present value helps you relate the cost, the purchase, the acquisition, investment, and its present value. So present value looks to the future. Net present value relates the value of the future to your cost in the present. Okay, so how is it calculated? There's two ways to calculate net present value. There's the longhand and then there's the shorthand approach. So we'll start off with the shorthand approach because I think this is really where the usefulness of a worksheet or a spreadsheet come into play. So net present value is easiest calculated when you first calculate present value and then you subtract your initial investment from that present value. So this begs the question, what function do you use? And this is actually where I have one of my biggest gripes with the syntax or nomenclature in Excel, where they're defining the function by a given finance term when the finance term may not match the operation. So in this case, we'll be using the net present value function in Excel to calculate the present value. So I understand that feels a little uncomfortable, so I'll say it one more time. We'll be using the net present value function, so equals NPV, to calculate the present value, not net present value. Why? So at first glance, you would assume, hey, listen, Alex is talking about present value. Let me use the PV function. The problem is that the PV function only works when you have a consistent, non-changing interval, and so interval amount of time, and payment amount. In every circumstance in real estate, your payments are going to be different. You'll collect a different amount in 1 month than another, in 1 year than another. So unfortunately, I think using the PV function doesn't work as well. So this is where NPV comes in. It's a bit more flexible in that it allows and accommodates for variable cash flows and variable time. So to illustrate the example, we have an initial investment of $1 million. You're going to own this property for 5 years, and you're going to collect this variable stream of cash flows. Rental payments less operating expenses and other items is going to give you the $70,000, but that amount is going to grow through time. At the end of the 5th year, you're going to sell the property. So in total, you have this summarized stream of cash flows, the acquisition, the operations, and the resale at the end. So Given a 10% discount rate, we'll use the net present value function. So if you'll notice, we highlighted all the cash flows after time period 0, all the cash flows after your initial investment. You don't want to discount the present. You don't want to discount time period 0 because there's no risk, there's no uncertainty, no time has elapsed. So we're going to discount everything from period 1 forward. Net present value helps us here because we can define first the discount rate as the first input, put a comma, and then we'll select basically all the cash flows that come thereafter. Close it out, and we'll get the estimate of present value. And so in this case, then the difference becomes what is present value less that initial investment. So if it's worth $1.210 million, 1.210 less the $1 million investment gives you a positive net present value of a little more than $210,000. And so I think from here we can begin to transition into what it means. Before we get there though, I wanted to show you the longhand way. So longhand, I think really just introduces another step, and that's discounting each cash flow individually. So first I want to show the function, and then I want to explain the function. So with every longhand kind of compounding or discounting, you'll want to identify periods, discount rates, and cash flows. And so in this case, if we take a look at the formula, we're going to say, let's discount $70,000 by the discount rate, the 10%, for one period. So if we can kind of explain it verbally, then let's kind of put a formula around that sentence. So we'll take the $70,000 and 12 divided by 1 plus the discount rate raised to the number of periods we're discounting, so an exponent of 1. So we can carry this forward, for example, where we take a look at discounting $1.578 million by 10% for 5 years. So what's key here is two pieces. One is that we're saying 1 plus the discount rate. The second issue is the number of periods that we're going to discount. So I think a couple things to take from this. First, the organization of your pro forma, your model, your analysis is going to be critical here to make sure that you have these assumptions set up in a particular way that makes it really easy for you to perform longhand math. Or you can rely on the shortcut or the shorthand way. So from here, I think it's how is it applied? And so if you kind of come back to either shorthand or longhand, what we're really defining is the value that you've created. So if you keep that in mind, let's talk about the different ways in which this is used. So the NPV function is used to kind of help establish value. So what is the value of the opportunity? So in this case, the $1.2 million. The net present value concept helps us define value creation or loss. So it's comparing the 1.2 to the million in this example. So it'll help us establish, is this a good investment or not? Not just simply what is it worth, but it's also important from the lender's perspective because they'll be applying present value and net present value concepts to help define what value the collateral, the property has, so that they can get comfortable with how much to lend on it. So if they say, Alex, we believe your estimate is $1.12 million, but we can't get comfortable with it. We think it's worth $1.2 million. And we're only willing to lend 65% of that $1.2 million. So the most loan we can give you on this property is $780,000. The product of 1.2 million times the 65%. And so lenders are going to be doing their own present value and net present value analyses so that they can get comfortable with how much to lend, proceeds, and magnitude. So again, just to kind of make sure that we're on the same page here, net present value is a critical function in Excel because it helps us calculate present value because of a variable stream of cash flows. That is separate from the concept in finance of net present value, which helps us define the value created in today's dollars. So one thing that kind of trips some folks up is that sounds a lot like profit. But if you think about it, it's not, because profit has no bearing on the magnitude of cash flows in the future or the timing of those cash flows. and your discount rate. There's no discounting or time value of money component to that. So to illustrate the example, if I told you you can collect $100 million 100 years from now, you would have a $100 million profit. But it's received 100 years from now. It's not really worth that to you today. And so net present value helps us define that present value worth, and therefore value creation or loss. So just to start to wrap up, we've covered a bit of ground here. So first, what is net present value? The value created or lost in today's dollars for a given investment. Two different ways to calculate it, longhand or shorthand. I'd highly recommend the shorthand way. Excel, calculator. If you're going to default to Excel, realize that the NPV function estimates present value, not net present value, and you'd still have to deduct that initial cost. And finally, how is it applied? It's applied in a couple different contexts. So what is it worth? How much should I pay? Two different concepts. And finally, what is the lender going to answer for that same set of questions so that they can determine how much to lend? So if you found this video helpful, I recommend you take a look at a handful of others. And as always, if you have any questions, comments, or feedback, I look forward to hearing from you. Have a good one.